Welcome! In this video, Xcn 47X will make a rise. What is the reason? We will analyze it. Don't forget to subscribe and like, and please watch till the end to understand.
A downtrend in technical analysis refers to a pattern where the price continues to move downward over a certain period of time. This pattern is usually seen on a chart as consecutive lower highs and lower lows. With each attempt, the price reacts from slightly lower levels, and the highs form lower each time. This appearance is a visual reflection that selling pressure in the market is stronger than buying pressure. The presence of such a downtrend indicates that the overall market sentiment is negative, and that most investors have not yet gained confidence. However, every trend has an end, and the end of a downtrend usually comes with a strong breakout. This breakout moment marks the beginning of a major shift in market psychology. In the current scenario, the downtrend the price is in may have created pressure in the market for a while. As investors see the price turning back from the downtrend line with each attempt, they begin to view this level as a resistance. This resistance line is where sellers take heavy positions. But over time, this selling power weakens. If the price reaches the upper line of this downtrend and breaks strongly upward, it means the dominance of the sellers has been broken. In technical analysis, this breakout is often interpreted as a trend reversal and is described with the phrase, "the attacks begin." Breaking a downtrend is not just about the price moving up a few levels. Behind this event is a strong psychological change. Investors who believe the trend will continue close or reverse their positions when the trend line is broken. This creates sudden buying pressure in the market, which causes the price to rise quickly. Buying attacks begin, and these attacks can sometimes lead to sharp increases in a very short time. Especially in markets like the cryptocurrency market, where liquidity can be lower at times, these breakouts can lead to much more dramatic moves. To understand this process more clearly, it's necessary to examine how the breakout happens. Usually when the price approaches the downtrend line, trading volume begins to increase. This increase is a sign that buyers are stepping in. If the volume rises significantly at the breakout moment, it confirms that the breakout is real. In false breakouts, the price briefly moves above the trend line, but falls back below it due to insufficient volume. That's why volume confirmation is very important for investors. The phrase, "the attacks begin," doesn't just mean the price is rising slightly, but that the first steps of a new uptrend are being taken. When a downtrend is broken, the price typically targets previous highs. These targets may act as short-term resistance levels, but if there's strong buying momentum, they can be overcome quickly. When investors see this breakout, they enter the market with the thought, the decline is over, the rise has begun. This multiplies the buying pressure. Psychologically, this breakout moment is very important because investors who have been in a downtrend for a long time feel great relief when the breakout occurs. This relief leads to increased positions and new buyers entering the market. At the same time, investors who are in short positions also buy to close their losses. This is called a short squeeze and can cause the price to move sharply upward in a short time. This situation is even stronger when the breakout is sudden and unexpected. At this point, it's important to note that after a downtrend is broken, the price often performs a retest. That is, the price first breaks the trend line, then settles just above it, and sometimes returns to that level to test it. If this test is successful, meaning the price holds above the line, it confirms the breakout's strength. After this confirmation, the attacks continue in a much more reliable way. To determine targets after a downtrend is broken, traders often use previous significant resistance levels, Fibonacci retracement ratios, or pattern targets. For example, if the price has formed a certain base within the downtrend, after the breakout, a rise equal to the height of that base can be expected. However, the strength of the attacks after the breakout can vary depending on the overall market conditions at the time, the news flow, and investors' risk appetite. In the situation you described, the price breaking this downtrend is not just a technical development, but an event that will create a major transformation in investor perception. Such a breakout means the negative sentiment that has been suppressing the market for a long time is dissipating. That's why the phrase "the attacks begin" is exactly the right definition, because this breakout moment starts a major change technically, psychologically, and in terms of volume, paving the way for the price to reach much higher levels. But we cannot decide an analysis only with trends, so let's look at the other metrics as well. Keep watching.
The Bollinger Band is one of the most popular technical analysis tools used to measure market volatility and statistically evaluate price movements. The basic logic of this indicator is to visualize how much volatility the price has shown around its average value over a certain period of time. In the middle, there is a moving average line, and above and below it are two bands determined according to the standard deviation of the price. These bands represent the range of price fluctuations. If the bands come closer together, it indicates that volatility in the market has decreased and price movements are squeezed into a narrow range. If the bands widen, volatility has increased and strong price movements usually occur. In the current situation, it is reported that there is a very large contraction in the Bollinger Band. This means the price has been trading within a narrow range for a long time, and the balance between buyers and sellers has tightened. When the market experiences such calmness for a while, it is often like the calm before the storm. The bigger the contraction, the greater the likelihood that the subsequent move will be strong. This is because during a contraction, both buyers and sellers go into waiting mode, volume decreases, and energy accumulates. When the price breaks in one direction after such accumulation, it often creates an explosive effect. When the Bollinger Band contracts, the first thing investors need to pay attention to is which direction the price will break. A contraction does not always result in a rise. It can also precede sharp declines. The breakout after the contraction usually occurs alongside an increase in volume. If the price breaks the upper band strongly and volume accompanies this move, it indicates the start of a large upward movement. Conversely, if the price breaks the lower band with volume, a strong downtrend may begin. This is why such contractions signal critical moments for investors to stay alert. A very large contraction often reduces the price's range of movement so much that the bands become almost flat. At this stage, the moves of large market players who take positions have a much greater impact. Even a small wave of buying or selling can push the price outside the bands and trigger other investors to act. This creates a domino effect. In the cryptocurrency market in particular, where liquidity can be lower at certain times, such breakouts can be much sharper and more sudden. A Bollinger Band contraction also signals an important turning point in market psychology. Prices trading within a narrow range for a long time test investors' patience. Many investors exit the market during this time and interest declines. However, real opportunities often arise when interest is at its lowest. Once the breakout occurs after a contraction, investors who had left the market try to return, accelerating the price movement. This is why a major contraction in the Bollinger Band is a signal that experienced investors follow very closely. The mathematical reason behind the explosive move following such a contraction lies in the change in statistical distribution. The Bollinger Band operates on the logic of standard deviation, so the price has a high probability of staying within a certain range. But when the bands contract, the range becomes so small that the price is statistically much more likely to move outside it. This breakout is seen by investors as the moment the trend begins and triggers sudden increases in positions. Such major contractions become even more meaningful when combined with chart patterns. For example, during the contraction, the price may form a triangle, pennant, or wedge pattern. In such a case, if both the pattern and the Bollinger contraction break in the same direction, the strength of the move increases. Contractions are usually opportunity moments for short-term traders because volatility explosions afterward can produce large gains in a short time. However, taking a position in the wrong direction can also result in losses just as quickly. This is why risk management is vital in this process. Returning to the scenario, the phrase "the price may explode soon" is exactly the result of this mathematical and psychological buildup. The longer the bands remain contracted, the sharper the breakout afterward will be. For investors to benefit from this explosion, they need to confirm the direction of the breakout. Direction confirmation requires not only moving outside the bands, but also closing above or below those levels. Otherwise, there is a risk of a false breakout. Breakouts after major contractions can sometimes happen in a single candlestick. For example, in the crypto market, a 1-minute or hourly chart may show the bands remaining contracted for a long time, and then a high-volume buy can push the price up by tens of %. Therefore, being ready and acting quickly during such moments is important. After the breakout, the price usually continues in the trend direction for a while, and the bands start widening again. This widening period is when the trend continues and volatility remains high.
Ascending channels are formations in technical analysis where the price moves upward in a regular pattern within two parallel lines. One of these parallel lines usually connects the price highs, while the other connects the lows. As the price moves within this channel, the lower line acts as support and the upper line has resistance. The middle band of the channel represents the average path of the price and serves as a reference point for short-term direction changes. The price behavior within the channel provides investors with important clues about both the strength of the current trend and potential breakout points. In the described scenario, the price is within an ascending channel and needs to break the middle band. This is a very critical point technically because breaking the middle band indicates that the short-term momentum of the price is likely to shift toward the upper line of the channel. When the price rises from the lower band of the ascending channel and breaks the middle band, it is the first strong signal that buyers have taken control. Once this breakout occurs, the likelihood of a rapid and strong rise toward the upper band increases significantly. Breaking the middle band of an ascending channel does not merely mean the price moves up a few steps, it also symbolizes a change in investor psychology. When the price rises above the middle band, previous short-term selling pressure becomes ineffective and buyers dominate the market. This builds the energy needed for the continuation of the uptrend. Investors who observe this breakout open new positions, increase existing ones, and support the price reaching the upper band. The significance of reaching the upper band lies in the structure of the channel. The upper line connects past price highs and is seen by investors as strong resistance. Moving toward the upper band after breaking the middle band generates a strong bullish signal both technically and psychologically. At this point, the potential magnitude of the rise is related to the width of the channel. The distance between the lower and upper lines shows the maximum range the price can cover during this move. In the described scenario, moving from the middle band to the upper band implies reaching the top of the channel from the current price level, indicating a potential increase of approximately 47 times. Such movements can be particularly dramatic in cryptocurrency markets. Breaking the middle band triggers short-term buying waves. Investors increase their positions to capitalize on the momentum created by the breakout. At the same time, this breakout can be supported by technical indicators. For example, the RSI indicator may move out of the oversold zone and gain upward momentum, while trend-following indicators like MACD may show bullish crossovers, confirming the strength of the rise. These signals give investors confidence that subsequent upward moves will be much stronger. Psychologically, breaking the middle band creates a significant shift in investor perception. When a price that has been moving within an ascending channel starts closing above the middle band, the market perceives that declines are now temporary. Investors, influenced by this perception, increase their positions, new buying comes in, and the price gains momentum toward the upper band. This creates a domino effect. As one group of investors buys, others follow, accelerating the move toward the upper band. Breaking the middle band is also critical from a risk management perspective. Investors can protect their positions with stop losses just below the middle band, allowing them to guard against potential pullbacks. Once the breakout occurs, the market is enabled to move in the trend direction, allowing investors to buy with confidence. After reaching the upper band, the price can achieve maximum potential growth depending on the channel width. In this scenario, moving from the current price to the upper band corresponds to an approximate 47-fold increase. This represents an incredible opportunity for investors. Such a large potential increase allows early positioned investors to earn significant gains. Breaking the middle band provides the necessary precondition for the rise and makes targeting the upper band possible. One critical factor to watch in an ascending channel move is whether the breakout is supported by volume. If the price breaks the middle band accompanied by an increase in trading volume, the breakout is reliable and indicates that the move toward the upper band will be strong. Conversely, breakouts without volume often carry the risk of being false and may result in the price returning below the middle band. Therefore, investors should monitor volume data carefully. Breaking the middle band of an ascending channel when evaluated together with other technical indicators forms an even stronger signal. For example, if the Bollinger Bands have contracted and the price breaks the middle band, the strength of this move is amplified. If the RSI also shows upward momentum, the price's movement toward the upper band becomes much faster and more effective. This combination represents a critical buying opportunity for investors. In conclusion, breaking the middle band in an ascending channel is not only a technical event, it also indicates a change in market psychology and investor behavior. This breakout allows for a strong move toward the upper band, and reaching the top of the channel from the current price level implies a potential increase of approximately 47 times. For investors, this type of breakout is one of the most critical and opportunity-rich periods in terms of both risk and reward.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.